He is a senior portfolio manager at AIP Asset Management, a hedge fund that focuses on convertible as well as private debt. Jay, nice to see you. Thanks for coming in.
No problem.
I said somewhat uncertain times. When you take a look at the market movement, the S&P 500 hitting a record high yesterday, it feels pretty good. But at the same time, too, we're actually seeing a very high bearish rate among institutional investors. How are you looking at the macro environment right now?
Yeah, and I think that's what it is. I mean, you sort of have to break it out into, well, what's driving the market returns, right? I mean, like if you looked at it historically, it's been earnings growth and it's been profit growth. If you look at year-over-year earnings growth this year, it's been anemic. It's actually probably negative. So why is the markets up? And the markets are up for basically two reasons, right? One is, will a China-U.S. trade deal happen? And the other one is, how dovish is the U.S. Federal Reserve going to be? And the way we look at it is, look, we can't predict what two people are going to do on a trade deal. Like, that's really like what we're not built to do. What we can look at it and say, look, what's the Federal Reserve most likely going to do? And we're saying, look, I mean, given sort of the backdrop of it all, I mean, they're most likely going to be dovish. But again, I mean, like now we're betting on nuances, right? Like if they're even marginally off, there's going to be a massive sell-off in the market. And so it's priced to perfection. That's where the concern comes from for us. And so we're looking at the markets and saying, look, we've had a great run. Maybe we should just reduce our equity position a bit. Maybe just sort of sit on cash for a bit. I mean, I'm not saying for longer periods of time, but maybe for a couple of weeks just to see where all of this sort of lands, right? Because we are priced to perfection at this point. If everything doesn't work out exactly the way it's supposed to, you're going to see a large sell-off in the market, and that's not the kind of risk we like to take, right?
So in our viewers should understand as well that you manage a hedge fund, but you also have traditional asset allocation for certain clients as well, segregated accounts, correct? So let's just talk about the hedge fund for a second, because you've won the Canadian award. You've also been nominated in the United States for your hedge fund performance.
Correct.
And you're focused on convertible debt as well as private loans.
Correct.
What's that environment looking like today? And I want to start with the private loans, because I feel like so many accredited investors have moved into that, and I think that a lot of mutual fund companies and ETFs are actually trying to also provide that for individual investors like us at home.
Correct.
How's it looking?
It's actually looking very good. I mean, I guess the uniqueness of our fund is that it's a combination of both. It's the private debt and it's fully convertible. So that's why you see the returns the way they are. So on a typical private credit or private debt fund, these are just private loans that generate sort of 8 to 10% interest. For us, we lend predominantly to the small cap market. We lend to companies sort of sub 200 million market cap. And ours is the same thing. So we generate 8 to 10% in interest income, but our loan is entirely convertible to equity.
Okay.
Right? So we're senior secured on assets. So we've got assets that cover the loan. And if things all work out, then we're going to convert and we're going to sell. And that's really good for the company itself, because in a traditional loan, let's say you borrowed $5 million. At the end of 2 years, you got to run around and try to find $5 million to pay them back. In our situation, it's because it's fully convertible. If the stock price goes up and management hits their targets, well, you never have to pay us back. We just convert, we sell our stock, and we're on our way, right? Yeah.
So in terms of the companies that you do invest in on the private loan front, it sounds as though they're all publicly traded?
They are.
Okay. What does that look like here in Canada? We don't talk a lot about the small cap, really small cap companies.
Yeah.
So how is it that you are doing the analysis and the vetting process here?
Yeah, the vetting process, it's actually sort of a 4 to 6 week process. So we actually...
Only?
Yeah. Yeah, so I mean, our due diligence is extensive. So, if, for example, if we're going to lend into a mining company, we're going to hire a third-party mining engineer, a geologist, a valuation expert, a third-party accountant to go through their books to make sure that they've been accounting for everything the way they're supposed to. Then it's our legal docs. We negotiate it, we underwrite it, and then we monitor the investments. So it's a real process, right?
Yeah.
But that's where sort of the downside risk protection comes from.
And Jay, why, we should explain to our viewers a little bit more about this private loan market and why it exists. Where are the banks in having a view or understanding that these small cap companies and their interest in even lending to them versus you? Yeah,
no, I mean, I guess the sort of post-2008 banking rules have really tightened. And so for the smaller loans, or even just the loans in general, they've come very conservative. So, the bank works like this. You go to the bank, you sit in front of a person. If you fall exactly into a lending box, they say yes.
Okay.
Anything outside of that lending box, they say, well, it's not really our territory. You go figure it out, right? So for example, like let's say you don't have 3 years of cash flow, right? Bank says no until you get there. So somebody has to lend you money for the
interim.
Yeah, exactly.
Yeah.
And so it's all really gap financing. It's, when can you jump in the market before sort of the bank ends up refining you out? So it's actually been a great market for both the investors, the issuers, and I guess even for the bank, because in some ways they're sort of taking on less risk because these lenders have been trained. They know what to produce. They know how to produce the information that the bank needs. And so they've got a track record of saying, hey, listen, somebody else lent them money for the last 2 years. They're a safe credit. We're going to refi them out, right? So I think it's actually just made the industry better.
And so, Jay, when you take a look at these companies that are approaching you, and you're actually probably, I'm sure, going out to find them, talk to us a little bit about the pool of opportunity. Is there a lot of opportunity within this area of companies looking for loans? And if that's the case, is that because they're looking for economic expansion, or is it because we're seeing economic contraction and it's even more difficult to get loans?
It's mostly for expansion, mostly for acquisition capital. And what we're finding, it's actually been quite unique, because historically, if you were less than 100 million market cap, you were sort of in no man's land, right? Like nobody really invested in you. Institutions couldn't actually invest in you because by mandate. And we always thought, that gap would eventually shrink. And what's happened is it's actually expanded because of ETFs. Because what you see with ETFs is as the money comes in, it goes into bigger and bigger companies, right? So like if you're TD Bank, for example, no matter what ETF somebody buys, you're probably getting $1, right? Like if you're in the high dividend, if you're in, I don't know, value, you're in growth, I mean, it's the same stocks that pop up. So now that expansion has gone to like 200, 250 million, where people aren't even really looking at these stocks. It's not really on their radar screen until it gets to like a particular size, right? So we're seeing a ton of demand for this product. And it's actually, and I think in some ways it's actually even better for the company. Instead of them sort of going out and raising $5 million, here it's a one-stop shop. You come, you negotiate your deal. And then you get someone that's done the due diligence, who understands your business, and who's going to stick around with you for the next couple of years, as we've promised to do, right?
Do you have much competition in terms of looking at these opportunities?
Not in our space yet.
Okay.
There's a lot of sort of competition in just strictly private debt, but not in ours. I mean, from our understanding, we're the only ones that do this with a conversion feature.
Okay, so most private debt funds lend the money and expect it back.
Exactly.
In dollar for dollar, as opposed to converting it into equity. Do you ever have a fear, though, that you're going to convert it into equity, the capital markets might not be in your favor, and there won't be the market cap and or liquidity for you to actually exit the positions?
So there's, I guess, two questions in that one. So one is the conversion capability. So the conversion is at our choice, and we never convert 100% day one. So what we'll do is we'll convert depending on how much liquidity there is in the stock. So, we might convert 10% at a time and slowly sell our position off. And the other part is, look, I mean, let's say the market would have dropped significantly and liquidity was gone. We're still secured to the assets.
Right.
Right? So we've always got a way of getting our money back.
You still have a company that you own?
Yes.
Okay. Shay, I always love talking to you. I always learn something different about the different markets, and I think that's a big takeaway. I think that viewers need to think about is that just given the lower for longer interest rate environment that we've been in, there are so many of these other areas that investors, pension funds have been investing in for so long now. Because they're accredited, but they are coming to the individual investor as well. So these are just things that we can be thinking about.
Exactly.
Fair point. All right, Jay, good to see you. Thank you
so
very
much.
much. That's Jay Ballas, Senior Portfolio Manager at AIP Asset Management.